Japanese mortgage rates just hit their highest point in over a decade. And if you own property in Japan, or you're thinking about buying, this single number could cost you millions of yen over the next 30 years. Here's the decision that's keeping financial advisors up at night. Fixed rate or variable rate? It sounds simple. Lock in your payment forever or gamble that rates stay low. But in Japan's bizarre economic environment, where interest rates were basically zero for 2 decades and are now suddenly climbing, the old rules don't apply anymore. Most people think they understand this choice. They don't, because what looks like the safe option might actually be the risky one. And the option that feels like gambling might be the smartest move you can make. In this video, we're going to break down exactly what's happening with Japanese mortgage rates right now, why they're rising, and most importantly, which type of loan actually protects your money. We'll compare the surface-level differences, dig into the hidden trade-offs that banks don't advertise, and give you 2 clear frameworks for making this decision. By the end, you'll know exactly which mortgage type fits your situation. Let's start with the basics of what you're actually choosing between. On the surface, the difference between fixed and variable rate mortgages in Japan seems straightforward. Let's look at what you'd actually see if you walked into a Japanese bank today. Fixed-rate mortgages in Japan currently sit around 1.8% for a 35-year term. That number is locked in. It never changes. Whether the Bank of Japan raises rates to 5% or drops them back to 0, your payment stays exactly the same from your first month to your last. Variable rate mortgages, on the other hand, start much lower. We're talking around 0.4% right now. That's less than a quarter of the fixed rate. On a 40 million yen loan, that difference means paying roughly 40,000 yen less per month at the start. That's nearly 500,000 yen saved in the first year alone. The mechanics are different too. Fixed-rate loans in Japan typically come with what's called a full-period fixed type, where your rate literally cannot change for the entire loan term. Variable rates in Japan adjust every 6 months based on the short-term prime rate, which follows Bank of Japan policy. There's also a middle option that many Japanese banks offer called the fixed-period selection type. You lock in a rate for 3, 5, or 10 years, then switch to variable or choose another fixed period. But here's where most comparisons stop. They show you these numbers and let you assume lower starting rate equals better deal. That assumption is about to get a lot more complicated. Let's be honest about why variable rate mortgages look so attractive right now. If you run the numbers assuming rates stay where they are, variable wins by a landslide. On a 40 million yen loan over 35 years, choosing variable at 0.4% instead of fixed at 1.8% saves you approximately 4.8 million yen in total interest payments. That's not a small number. That's a nice car. That's a year of private school tuition. That's a complete home renovation. And variable rate advocates point to Japan's unique history. For over 20 years, Japanese interest rates barely moved. People who chose variable in 2005 paid less every single month for almost 2 decades straight. The Bank of Japan seemed permanently committed to ultra-low rates. Even now, Japanese variable rates include a safety feature that many other countries don't have. It's called the 5-year rule and the 1.25 times rule. Even if rates spike dramatically, your actual monthly payment can only increase by 25% every 5 years. The bank absorbs the difference in the short term. Meanwhile, fixed-rate mortgages come with their own apparent disadvantage. You're paying a premium for certainty. That 1.4 percentage point difference is essentially insurance money going straight to the bank. If rates never rise significantly, you've paid millions of yen for nothing. So why would anyone choose fixed? Because the story I just told you is missing some critical information. Here's what the attractive variable rate numbers hide. That 5-year rule and 1.25 times rule I mentioned, they don't actually reduce what you owe. They just delay when you pay it. If rates rise faster than your payments adjust, the unpaid interest gets added to your principal. You end up owing more than you borrowed. It's called negative amortization, and it's a trap that catches people who think they're protected. And those rates are rising. The Bank of Japan ended negative interest rates in March 2024 for the first time in 17 years. They raised rates again in July. Governor Ueda has signaled more increases are coming. The era of zero rates is officially over. Now let's run different numbers. If variable rates rise by just 1 percentage point over the next 5 years and stay there, your total interest payments increase by approximately 2.1 million yen compared to locking in today's fixed rate. If they rise by 2 percentage points, which many economists consider possible, you're looking at over 5 million yen in additional interest. But here's the trade-off that surprises most people about fixed rates. Japanese fixed-rate mortgages often come with higher prepayment penalties. If you want to refinance or pay off your loan early, you might face fees that variable borrowers avoid. And fixed rates lock you into today's spread. If the Bank of Japan reverses course and rates drop again, you're stuck paying the higher rate while your variable rate neighbor enjoys cheaper payments. Neither option is purely safe. Both are gambles. You're just betting on different outcomes. Let's establish the first framework for making this decision. It's about cash flow flexibility, and it's more important than most people realize. Ask yourself this question honestly. If your mortgage payment increased by 50,000 yen per month next year, would that change your life? For some households, that increase is annoying but manageable. They have savings buffers, dual incomes, or expenses they could cut without real pain. These households have high cash flow flexibility. For other households, that same 50,000 yen increase means choosing between the mortgage payment and their child's juku fees. It means canceling family trips. It means genuine financial stress. These households have low cash flow flexibility. Here's the framework. If you have high cash flow flexibility, variable rate mortgages make more mathematical sense. You can absorb potential rate increases, and you benefit from the lower starting payments. You're essentially self-insuring against rate risk. If you have low cash flow flexibility, fixed-rate mortgages provide something more valuable than savings. They provide certainty. You know exactly what your housing cost will be for the next 35 years. That certainty lets you plan everything else in your financial life with confidence. But here's the nuance most advisors miss. Cash flow flexibility isn't just about your current situation. It's about your projected situation. If you're early in your career with likely salary increases ahead, your flexibility will grow. If you're approaching retirement with a fixed pension, your flexibility might shrink. Variable makes more sense when your flexibility is increasing over time. Fixed makes more sense when it's stable or decreasing. The second framework is about time horizon, and this is where the math gets interesting. How long do you actually plan to keep this specific mortgage? Most people answer 35 years because that's the loan term. But statistically, they're wrong. The average Japanese homeowner sells or refinances within 13 years. Job transfers, family size changes, divorce, inheritance, neighborhood decline, earthquake damage. Life happens. If your realistic time horizon is under 10 years, variable rate mortgages have a structural advantage. Even if rates rise significantly, the total interest you pay during a shorter period is limited. You might sell the house before rate increases compound into major costs. The lower starting rate gives you guaranteed savings in the early years when you're most likely to still own the property. If your time horizon is genuinely long-term, the calculus flips. Compound interest works against you with variable rates in extended scenarios. A 2% rate sustained over 30 years costs dramatically more than the same rate over 10 years. The fixed-rate premium becomes worthwhile insurance over longer periods. But here's the critical insight. Your time horizon and your cash flow flexibility interact. Someone with low cash flow flexibility and a short time horizon might actually handle variable better than someone with low flexibility and a long horizon. The first person faces limited exposure to rate increases. The second person faces decades of potential payment stress. Map yourself on both axes. High flexibility plus short horizon strongly favors variable. Low flexibility plus long horizon strongly favors fixed. Mixed scenarios require more careful analysis of your specific numbers. Let's make this concrete with profiles. Variable rate mortgages fit best for several specific situations. First, young professionals in their late 20s to early 30s with growing incomes. Their cash flow flexibility will increase over time, and they'll likely move or upgrade before rates compound significantly. Second, buyers who keep substantial liquid savings. If you have 2 years of mortgage payments in accessible accounts, you can weather rate spikes without lifestyle changes. Third, real estate investors who plan to sell within 10 years. The lower initial rate improves cash flow for rental properties, and the exit timeline limits rate exposure. Fourth, anyone with prepayment capabilities. If you can make extra principal payments when rates are low, you reduce the base that rate increases apply to. Fixed-rate mortgages fit best for different profiles. First, families with children approaching expensive education years. Japanese high school and university costs are predictable. Your mortgage payment should be too. Second, single-income households or those near retirement. When your earning capacity is capped, payment certainty becomes essential for planning. Third, buyers of forever homes in desirable areas. If you genuinely plan to live somewhere for 20-plus years, rate protection has time to prove its value. Fourth, anyone who loses sleep over financial uncertainty. The psychological value of fixed payments is real and worth paying for. There's no shame in buying peace of mind. The middle option, those fixed-period selection types, fit people who want lower initial rates but expect their situation to change within 5 to 10 years. Japanese mortgage rates are rising. That's not speculation. It's happening right now, and it will continue. But the right choice between fixed and variable isn't about predicting exactly where rates will go. Nobody knows that. The right choice is about understanding yourself. Assess your cash flow flexibility honestly. Not optimistically, honestly. Consider where that flexibility will be in 10 years, not just where it is today. Estimate your realistic time horizon for this specific property. Then place yourself on both axes. High flexibility and short horizon points toward variable. Low flexibility and long horizon points toward fixed. Everything in between requires running your specific numbers with multiple rate scenarios. One final thought. The worst mistake isn't choosing wrong between fixed and variable. It's overborrowing in either format. If rate increases or payment stability won't matter because you borrowed at the absolute maximum the bank allowed, you're in trouble either way. Leave yourself margin. In Japan's new era of rising rates, that buffer matters more than which rate type you choose. If this analysis helped you think differently about your mortgage decision, subscribe for more deep dives into Japanese business and economic trends. The financial landscape here is changing fast. We'll help you stay ahead of it.